Hey everyone, and welcome to today's training. In this session, what I really want to do is give you all a bit of an insight into how we like to look at our numbers and how we showcase them to our clients to make sure that they're seeing the key metrics and the key numbers that they really need to be looking at to make better, smarter, more informed business decisions, and really how they need to be looking at their business to make sure they're building an asset that's going to give them really, really strong returns long into the future. So stick around. It's going to get technical. There's going to be a lot of numbers. We're diving into a spreadsheet. But if you learn and understand what I'm talking about in these trainings and you implement them into your own business, or you start to even just think about them, then you're going to be in a much stronger position moving forward to make sure that you're making better decisions for your business. Now, for those who don't know me, my name's Troy Larkham, client advisor here at Trade Business Accountants, and we work with Australian trade and construction businesses, typically turning $1 to $10 million a year, to help them skyrocket their profits, fortify their business, and make more cash. So with that being said, let's dive in. What we've got here is, again, we've got the profit and loss area, the balance sheet, so that's getting pulled from the balance sheet section, and then this is calculating cash flow. Yeah, so for these last 3 months, your total sales revenue is 275. Our quarterly target based off those new targets that we set, which is in order to achieve this, you're ahead. So you're up $25,000 from the target that you should be at this point, which is fantastic. That's a 10% difference, so that's great. Our quarterly target here was $92,000 in pass-through costs. We've got $97,000. It's a bit more, but it's okay because we've actually got an extra $25,000 in revenue going on there. So when we come down here, once you minus your pass-through costs from your total sales revenue, what we end up with is $178,000 in net revenue, our engine room side of things. And our target was $157,000, which is really good. So we're $20,000 up for that quarter relative to target. So this is good. So this is showing, hey, we're ahead of where we actually need to be for the last 3 months. Here, our direct labor cost, we've got a target of $85,000. Our cost has only been $78,000. So that's even further win. We've saved cost there. And then here, our labor productivity ratio target was $1.85, which I believe is very similar to one that we had before. Might have been $1.83 in the other sheet. Currently, for the last 3 months, you've averaged $2.26. So really, really solid. And again, I guess I'll just take a step back. The reason why we're looking at it quarterly is it gives us a much better insight of what's actually going on. Because you'd know, like in your field of work, working projects and whatnot, is you'll have 1 month, you make a load of sales, but you don't have many expenses. Then the next month, oh, there's not much sales, but a whole lot of expenses come through, and it just looks really volatile. So to look at that month on month, you're just not getting really any clarity. Whereas looking at it from an averaged over 3 months, we're getting a much better and clearer understanding of what's actually going on. Continuing on here, $2.26, so really solid. Our gross profit then is at $99,000. Our target was $72,000, so we're ahead 17K. Our quarterly total target was at 29%. You're currently at 36% for the last 3 months, which is really, really good. So when we come back to our performance targets, this is our target for the year, 29%. If you can maintain above that 30% for the rest of the year, you'll nail that, especially if you keep being ahead in terms of the total revenue sales figure here. So yep, that's positive. We've got a 7% difference, which is great. No management labor costs, no management productivity ratio. And non-salary based operating costs, we had budgeted $47,000. You're actually $60,000. So obviously we just noticed that before because the target was down to that $15,000 a month, where realistically it should be up to that $18,500 mark. So we'll have to, I'll readjust that number in a second so we get some more accurate numbers going on there. Looking at this, at the end of the day, our target of operating profit for the last 3 months is $25,000. You've hit $38,000. Really, really good. You've achieved 14% for the last 3 months. Really, really solid. So this is where, because if you remember back where we talk about, if you're achieving a 0% profit margin, you're in seriously dangerous territory because chances are you're not breaking even from a cash flow perspective. If you're at a 5% operating profit margin, where you're at what we like to call life support, where on paper it says you're making profit, but typically from a cash flow perspective, you might not be breaking even, or you're just breaking even. Because if you think about even one fact alone from Xero says that on average 5 to 15% of revenue goes uncollected every single year. So if just 5% goes uncollected, boom, you're only breaking even from a cash flow perspective, and that's one area. So, and then 10% is what we like to call a good business. and then 15% and above is a great business. So you're 1% off from being in that great business area. So overall, looking really, really positive. But here's what I was saying before. We've got our operating profit like we saw in your one. So we have $23,000 in June. July, we had negative 1,700. In August, we got $16,000. So most business owners would look at their profit and loss, go, I've made money, I've lost money, I've made money. But you'll remember from the cash flow masterclass, profit's only one chapter. We need to consider working capital and other capital. So if we come down here, I'll come back to the balance sheet side of things soon. But from these months in June, your working capital invested actually went down $6,300. So what that means is, and we noticed this when you started getting collections a lot faster and you started following up on those aged receivables. And I saw you went from like $147,000 in aged receivables down to $75,000 or $78,000 or something. Just really, you really got on the ball with that. So as you can see here, you went from making an extra $6,000 in, so some context again. So $23,000 the first chapter. Then we've got, well, you haven't invested any more in working capital because you've gone and collected that money. Well, that's an extra $6,000 in cash on top of that $23,000. And then other capital invested as well, for whatever reason, maybe you've sold something or whatever it was. Again, I didn't go into that level of detail, but from these calculations is you've also made an extra $2,300 in cash because something's been removed from other capital. Either you've sold something or something's happened in that period of time. So with that, 23,000 plus 6,000 plus 2,000, you've made $32,000 in cash. That's what's going on there. We go to the next month, July. We look at this, negative $1,700 in profit. So you would look at that and go, ah, shit, that's not good. Now, from a profit and loss perspective alone, you'd be right, 100% right. If you were looking at that, it doesn't look very good. Negative 2% operating profit margin. But because of your efforts in the receivable side of things again, you've actually brought in or reduced, you've not invested, but you've reduced your working capital by nearly $40,000. So in this case, you've added an extra, so even though you've got negative $1,700 there, you've just added $40,000 in cash. And then other capital as well, $5,000 there. So totaling $53,000. That's that figure plus that equals that. So we've got 32,000 plus 43,000. And this is where you were saying how from your bank account, your partner was saying, hey, where's all this cash come from? This is it. This is where it's come from. So you went from about 20-something thousand in your bank account plus $75,000 over the last 3 months. Now you're in the $90,000 range, which is where your bank account is, I believe, right now. Now you'll be able to start to gauge as you use this tool a much better insight of why the hell is all this cash coming? What's been going on? You start to get a better handle on that. But I'll take a step back. If we look at this one, so August, $16,000 profit. Looks good. We're at a 19% operating profit margin. However, in this month, you have had an increase in working capital invested. And again, I'm not 100% sure what it is. Maybe you've slowed on the debt collection side of things. Maybe there's been a huge opportunity of growth and workflow coming in, which means you've got more works in progress, which is naturally going to increase that working capital. There's a whole bunch of variables and factors there involved. So there's been an increase in $15,000. So when it's positive, this figure, that means it's draining $15,000 of cash. So $16,000 here, that's positive cash. From that $16,000, we've got a minus $15,000. So now your cash flow is only $1,000 at that point. But then other capital invested, well, in this month, you've spent $1,600 in other capital, which brings your cash flow, even though your profitability for that month was $16,000, your cash flow is negative $600. But this is why we want to be looking at it from a 3-monthly basis. This isn't saying this month bad. There's going to be a range of things that have happened here. For example, there's the vans, there's a whole bunch of costs and expenditure that's going on here. We don't want to just look at it as a month. In general, your last 3 months have been really solid. You've averaged a 14% pre-tax profit margin. You've made $75,000 in cash. And if we look to here, your cash safety net, just from June alone, grew from 50. Well, actually, if I just go this back to July, you went from $22,000 as your cash safety net to $95,000 in July. So that's where we went. This plus this equals this. This plus this equals this. And that's what's going on there. So you start to see a bit of a better idea of your cash inflows and outflows and understanding where the cash is going. So if I just go back to August now, So here, coming to the balance sheet section. So we've got accounts receivable days. Now, if you remember back to the cash flow masterclass, that's the days in which it's taking you to collect money from customers. So obviously, the shorter those days, the better. Because if they're really, really long, it means that for once you deliver work and then invoice a customer, it's taking you a really long time to actually get the cash in the door before the customer pays me. So what you want to do is bring that number down. So I've just got some random numbers there. I've got 45 days. You've actually achieved, this month was 25 days, this month was 27, this month was 34. If we look at that, we can actually see your average is 29, but something to note here is you've actually had an increase in receivable days. So that means that's a hint to you to go, hey, I need to get back on top of my receivables, because we're seeing an impact here with our working capital invested as well, where we've had an extra $15,000 increase in likely the receivable side of things. And that's coming from our increase in receivable days. We've got to get back on top of that, start collecting that money, getting it in the door. We've got to keep on top of that cash flow. So looking at that, you've got 30 days. So that means on average of the last 3 months, it's taking from the point you invoice, it's taking you roughly 30 days to actually collect the cash, the payment from that invoice. Payable days, again, this is the opposite now with payable days, because the longer you can hold off paying your suppliers from when you either get it from Reese or if they invoice you, and you can slow down that payment, that's better for you because you're holding the cash. But it's a double-edged sword though. You don't want to go too far that you're pissing off your suppliers that they don't want to use you anymore. It's a healthy management of that. But looking at this in general though, the average is 52. Our target is 45. Again, that's just a random target I've pulled. So positive. WIP and stock is similar to accounts receivables. Is the longer you hold stock or the longer your work's in progress, the worse for cash flow, because that's the distance between from when you've bought something to when you actually invoice it to a customer and then get paid for that. So we want to shorten that time. So like with works in progress with your projects, you want to be invoicing, as early as possible and as frequent as possible, rather than doing work and then invoicing at the end, because then you've just increased your works in progress really large. Similarly with stock, if you're, for example, buying a whole heap of random different branded stuff, say that toilets, there's a whole bunch of random brands in toilets that are there, but you typically use one brand, well then those other items are going to be sitting in stock for a longer time, which isn't good because you outlaid the cash for those 40 days ago, but it takes you, and you still haven't sold it. It might be another 40 days before you sell that because it's a more unique item. So we want to limit those stock days. The less you hold stock, the shorter you hold stock, the better. Cash flow is once you get your head around it, it's a very simple concept. You don't want to be losing cash, and you want to be bringing cash in as fast as possible and as much as possible and as frequent as possible. That's the game of business, really. To survive, that's the focus. But again, looking at this, the final item, your cash safety net, we've gone from 51,000 to 95 to 93. So there's been that drop because of this increase here. So if you can get back on top of those receivables, September will immediately pop right back up. So you'll easily go into the 6 figures with your cash safety net. What is cool though, you've got $93,000 there for the quarter. So your quarter is it's not an average, it's just the final figure. That's what's in the bank. But your target here is 47,500. So that's your emergency capital safety net buffer. So all that is a 3-month total of your non-salary based operating expenses. The higher, the better though. In fact, I would actually push that further and say, because you've got no management labor cost, but you do have direct field labor cost, actually, let me just figure this out now. I'll bring that in here. So looking at that, you've really started building towards that, which is fantastic. Because if you get to that point, that means you can cover your non-salary based operating expenses, your management labor costs, which is 0 at this point, and your field labor costs. So you can cover everything comfortably for 3 months if no work came through the door anymore, and it was just pure expense, no input of cash. And that's purely just there for just a worst case scenario. You never know what's going to happen. For example, let's say one of your builders who's responsible for 80% of your revenue walks away. You've got 3 months there to find a new client and fix that up. Now, 3 months, obviously, if you can build that to 6 months and then 12 months, fantastic. But you compare 3 months to 2 weeks, I would take 3 months any day of the week. All that's doing is just giving you that breathing room to make sure that you can comfortably get through those ebbs and flows that happen in business, those storms that are imminent to happen. We want to make sure we've got the cash buffer there in place, because what we don't want to do is have a week or 2 weeks of cash buffer that run out overnight, and then you're having to go look for credit lines, because that's a really slippery slope, because then you're one bad cycle away from losing everything and being in massive debt. That's the worst thing you want to do. So where the direction you're heading now, fantastic. You've gone from 20 to 50 to 95. This month is 93, so it's stabilized. Next month, let's crack it over into the 6 digits. Following, we'll keep pushing in that direction. If in 6 months' time we get to this 132 figure, fantastic. With that matched with maintaining this 14% or just above 10%, you are in a really solid position. And from there, we'll continue to optimize and make sure you're in a great position. And with that position too, you'll have, again, you've got more cash here now to fund bringing on new guys. You can cop a bit of a loss to begin with if you just want to get an A player on, if the opportunity presents itself, but you don't necessarily have the work to fill him up straight away. You've given yourself some time to be able to, reach out, build new relationships, get him onboarded. But it gives you the confidence moving forward to be able to start making better strategic decisions without that thing in the back of your mind going, oh, if this doesn't work out, the business is going into the negative. That is the worst place to be in. Really bad place. With your profits and your cash, what should you do first? So obviously with $132,000 in the cash in the bank account, it's going to be really tempting looking at that to go, oh, pull some out, for some personal use and, take some distributions and whatnot. I strongly recommend work towards the $132,000 safety net. Once you're there, imagine that's your new 0 point. And then we can start having discussions with once you go above that. This will, if you grow your team and grow your business, this will increase. So something we talk about is if you were over the next 3 years, grow this business to a $5 million business, then I would strongly recommend you do not take any profit distributions out, because your business is going to need that cash to, one, keep building this capital safety net. For a business that's 5 times the size, because it's still 5 times the revenue, now we need $600,000. So you'll need to be building that over the 3 to 5 years that you're building towards that $5 million company, just to make sure it's healthy. Likewise, we need that cash there, because we need to make sure in this process, when you're growing from $1 million to $5 million, there's going to be a huge substantial increase in working capital invested, because there's more opportunity. You bring on more guys. What happens there is there's going to be a growth in receivables, because there's more work coming in the pipeline that you're then invoicing. There's an increase in works in progress as well, because again, the pipeline's there and there's going to be a bigger amount there. Stock, whatever way you want to look at it. So you're always going to end up naturally, as you grow, this one will always be stealing cash from you. This one likely will be as well, because you're buying new equipment, new vehicles and whatnot. So that'll be stealing cash from you as well. So it's really important in that process that you remain profitable to be able to fund these areas, because that ensures you don't need to go for third-party financing or loans or anything like that, because your business is being funded by its internal capacity of profit. So profit is the only way to be able to fund internal growth. And that's the only internal source of funding. If you want more funding on top of that, you've got to go outside of the business and look for loans. But if you can fund it, really stably and consistently over the 3 to 5 years, that's a really, really good business. The key with it though, because you're probably listening to that going, oh shit, making no profit, no distributions, just paying myself 100K over that period. That doesn't sound very good. It's about having that long-term perspective, because business, we probably talk about this all the time, is an asset. And one thing to consider is once you, for example, let's say you grow to that $5 million point and you go, I'm done. I'm happy with this size business. This is where I want to stay. We go, fantastic. The moment you hit that $5 million point and you don't want to grow anymore, there's no longer an increase in working capital because you're not growing. You've stabilized, and there's no longer an increase in other capital investment. Of course, there's going to be little things with the variances in business, and you might buy a new asset and stuff, but that's very minimal. But that will all largely stabilize and come under control. So what that means, if let's just assume they're zero, so they're not stealing cash or they're not giving you cash, just for example's sake. Operating profit then, this is $38,000 for, well, actually that'll be $40,000 for the quarter. So that'll be $160,000 for the year. Now that's $1 million business though. We're talking about a $5 million business, and you can still maintain that, that's $160,000 times 5, which is looking a lot more favorable. So, $700,000, $800,000, whatever that comes out to. So with that, rather than, in the short term, you could stay as $1 million and start taking distributions out, but you're only capping yourself to $160,000 in profit for the year. Whereas if you reinvest that $160,000 into the business growth in working capital and other capital for 3 to 5 years, grow to that 5 million, maintain this profit margin. Now you're pulling out $800,000, which is a lot better, lot better. You're not saying that you will pull that out, but you have the capacity to, if you if you don't stop growing beyond that 5 million. And this is the whole idea that we're talking about with businesses. Is the key in business is return on invested capital. So at that point, you might have here, like we said, this might be $500,000 in your cash safety net. So that's the capital sitting in the business. If you're making $800,000 to $900,000 in your profit, that means your return on invested capital is 70 to 100%. Now you compare that to dumping money into real estate or shares, you might get 7%, 8%, 10%. So again, you do like what we talk about in business. You don't want to just put all your eggs in one basket with the business and just keep going that way, because you want to diversify your income and but what you want to be doing is, this is your trading entity. You use these funds to then, take distributions out and then invest in other areas like real estate and so on, because you want to diversify. But what you don't want to do is start pulling money out too early, in the first year, to then throw it into those areas. I strongly recommend focus on building the business, build that capital base. So there's $500,000, $600,000 sitting in the business, and then you're making $800,000, $900,000 a year in profit. Because with that, you're getting a really, really strong return on invested capital for years and years to come. And then you'll have a substantial amount of funds to be able to get the best operations managers, the best tradesmen, the best people in your team, implement the best systems. So it just becomes a really, really streamlined operation for you, which is very favorable. And then obviously that's benefiting the lifestyle side of things. So this is just, it's a different way of thinking, but this is really how you want to use your business. It's an asset. You want to be thinking about return on invested capital. And that all starts with, looking at these numbers like we're doing here, and moving forward, making sure that you continue to maintain these margins that you've been hitting for the last 3 months, which is fantastic. And you continue to have a hold on your working capital, so your receivables, your payables, your WIP and stock. Because even though you're not technically measuring your works in progress or stock, it's still a real cost that exists in your business. You just don't have a process to manage it right now, and that's okay. Down the line, you will want one. But for now, you will know that actually is still a real cost that's affecting your business. It's just not being measured right now. But with that in mind, as long as you keep in mind with works in progress, you want to limit it as much as possible. That means invoicing as early and frequently as possible, getting as much money up front as early as possible. The less money you have to collect at the end of the job, the better. That's the best thing you can do for cash flow, versus the other way. If you're leaving all the cash to be collected at the end, that's not good for cash flow, because you're extending everything. Your works in your receivable days, your payable, everything goes up. Your WIP days, sorry. So that's something to keep in mind. And then other capital invested is, that's just being conscious about the other areas, which are going to be, obviously your assets, your financing of vehicles and stuff like that. So that all sits in that area. But mainly your focus will be operating profit and working capital invested. You keep those two areas in control, and you keep growing the business and building your capital safety net, get it to that 132. Then as you grow, that figure will keep increasing. And we keep maintaining all that. You are building a really, really, really strong asset.